This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So I've covered the oil and gas industry extensively on the podcast over the years, but what about alternative energy? This would be areas like solar, wind, all the clean energy areas. Several of you have been asking me about it recently, so I thought I'd take a look this week to see, are any of these stocks values? And if they are they value traps? This is our favorite type of analysis. And I haven't done it for a while because the coronavirus sell-off has kind of taken us away from this. But I was curious to see what's happening with these earnings estimates and whether or not a lot of these stocks wouldn't be traps. But before we get to the diving in, remember what the definitions are here. So a value stock is cheap, a cheap stock by classic fundamentals. Usually that means the low PE, price to sales ratio, PEG, price to book ratio. You can use one of them, all of them, combination, depends on how much value you really want to focus on. I usually just use forward PE for this because that's easy. Everybody knows what that is and likes to use the earnings. So that's what we're going to use. So there's value stocks and then there's the traps. And those are usually discovered by finding out that, yes, while the stock is cheap, it's actually had a decline in earnings. So when you go in and you look at the earnings situation, you find out it might be cheap for a reason because those earnings estimates are being cut and the earnings are on a decline, usually from the year prior, so a year-over-year decline. Although this year, it'll be interesting to see, again, what's kind of happening with these. Now, I call like some of the value trap stocks are kind of a fake out, right? Because they appear to be values, but in reality, they really are the trap. So we want rising earnings estimates if we can get it, plus the cheapness. That is the best combination. So now let's dive in and see what is actually going on in this industry and whether or not there is some value here. So I didn't run a screen for this podcast. I just kind of pulled out 5 alternative energy stocks that I knew were out there that I'm kind of familiar with, although a couple I wasn't. But once you find one, you can kind of look around and see what everyone else is talking about with that one, and you find other ones. And then it had to have a Zacks rank. I didn't care what it was, but surprisingly, these were all 2s and 3s. So 2s are the buys and 3s are the holds. So we didn't get any that were 4s or 5s in these 5 stocks. So that's good. And that could indicate maybe something positive with these earnings estimates here. But let's dive in. And I'm going to start off with the hottest stock in alternative energy. Many of you probably have heard of it or you follow it on StockTwits. It's always on the ticker on CNBC, and it's EMPH, ticker EMPH. I used to own this in Insider Trader. We had a big gain in it. I think it was last year because some of the insiders have been buying in there on the big pullbacks. It's very volatile. If you look at that chart, it's now up 86% year to date, and it's up really big off those March lows. So it's pretty hot here. This one is not a value here anymore, PE of 50. So we're not even starting off with the value, whether or not it's a value trap, but the estimates don't look that bad on this one. So 7 estimates were cut in the last 60 days, and then 1 was raised. So the vast majority are a little more bearish. This isn't surprising given what we've just been through, and that some of those estimates are coming down, but the full year estimate is calling for 102 versus just 120 60 days ago. So only cut 18 cents, and that's still an earnings gain of 7.4% year over year. So despite the coronavirus crisis, this company is expected to still grow earnings year over year. But as you might expect, a lot of the alternative energies don't really have the exposure to the shutdowns, the government mandated regulatory stuff that's going on right now. And Enphase, in case you don't know, I got this off their website, is the world's leading supplier of solar microinverters. So the solar side is still pretty hot, as you'll see in a moment, because I'm going to cover some more of those. But Enphase, one of the hottest ones, everybody's trading it, but not cheap here, but not a trap. I would say this is a growth stock right here, with not much of a trap, as those earnings are expected to grow. Okay, then switching to stock number 2 is First Solar, ticker FSLR, and many of you know them. They've been around a long time. They are off their website here, the leading global provider of comprehensive PV solar energy solutions. And year to date, these shares are now down 7.7%, up big again, just like everything, off the March lows, up 17% in the last month. So what's going on with their earnings estimates? One is lower over the last 30 days, 5 are lower over the last 60 days. So there have been some estimate cuts there. Again, not surprising given what's going on. But full year expected to make 271 now versus 321 just 2 months ago. So that's where the estimate cut has come in. It's 50 cents. But they only made $1.48 last year. So that's earnings growth of 83%. And now what does their PE look like? Are they a value? Well, it's a little bit elevated here, but much better than Enphase at 19.5 times. So not technically value stock. I look for stocks under 15, but not super expensive given that really strong earnings growth of 83%. Now, a lot of the analysts in the solar industry do expect a turnaround in that industry in the second half of this year. These earnings estimates, while they were cut, are portraying at least some strength this year compared to last year. So that's First Solar, FSLR. Then switching over to Canadian Solar, they are even cheaper here. And if you don't know them, they are one of the world's largest solar power companies and a leading manufacturer of solar PV modules. So they, like I said, are much cheaper. PE is just 7 here, 7.1. Shares are down 17% year to date still. Over the last month, they have rallied off the worst of it, but they're still down 1% over the last month. So not seeing quite as big a rally here as some of the others, but still off those lows. Now, what do the estimates look like? So 3 estimates are actually higher over the last month. And the 2020 estimate, Zacks consensus estimate here, is looking for 269 versus 207 just a month ago. So they came out with their earnings not that long ago. It was okay, but the guidance and outlook going forward again into the second half of the year was much better than expected. So then now this is where we have the rising earnings estimates. So that's pretty rare in this environment. Everybody else is being cut, but Canadian Solar is not. Earnings expected to be up 22.8% year over year because they only made $2.19 last year. So if this 269 holds, this is not a value trap. This is a good value stock. It's a Zacks number rank 2 buy right here. So a lot of good things looking positive for Canadian Solar. But if you take a look at the longer term chart, the street is not super excited about a lot of the solar stocks actually. But maybe that's where the value investor can actually get a buying opportunity, right? Okay, switching on to the 4th stock, it's Renewable Energy Group. REGI is that ticker, and they are they're leading the transformation of biofuel into something that helps improve the environment. So this is biofuel side of things. PE is really cheap on this one too, 8.2. So we do have maybe a value stock, but what do those estimates look like? So one estimate has actually gone higher in just the last week on this one. The Zacks consensus is calling for $3.98 now for the year. That is down from $4.95, so down a little over $1 year over year, but still expected to be up 6.1% versus last year because they only made $3.75. So we got a little bit of earnings growth still, even though those estimates have come way down, and that's a positive. So no value trap here on this, just a cheap stock as well. Year to date, these shares are up 20%, and over the last month, they're up 10.5. So they have bounced again off the lows, like everything has, and but still cheap here. They are a ZAX 3 hold here. So that's Renewable Energy Group, REGI. And then we're going to round it out with Solar Edge Technologies, SEDG is this ticker. And they say, invented an intelligent inverter solution that has changed the way power is harvested and managed in a solar PV system. So again, this is the solar side. PE here is 36.6. And that is, pretty pricey. That's not a value here. So this is on the growth side. But what do the estimates look like? We're going to take a look anyways. 5 are lower in the last 60 days. None are higher. And it's now calling for earnings of 4.07, so $4.07. Sorry, I'm reading that off. $4.07 versus $5.25 just 2 months ago. So those estimates, like everything, have been cut, but year over year earnings growth expected to be down 8.3% now. So the story not quite as bullish with Solar Edge here, and it's expensive. So I'm not liking that quite as much here. So they are ZAX number 3, however, that's the hold. So I also took a look at, just out of curiosity, one of the ETFs, the Ishares Clean Energy ETF, that's ticker ICLN. And they have 30 companies in that ETF. It was begun in June 2008. And I don't know if you remember 2008, but this was during an election season, and there was a lot being talked about alternative energy, and especially solar, right before the big financial crisis happened, basically. And so these stocks were pretty hot then, but then they weren't. So since inception, this ETF is down 11.2%. The 10-year return is down 4%, 3 years up 6.4%. So, like I said, these clean energy stocks just haven't really done anything over the last 10 years. A lot of them are pretty cheap, but unless you can get them like super dirt cheap, kind of like Canadian Solar is, then you'll see if you can get something out of that if the street starts to recognize, hey, maybe this story is turning around. But it's been a tough go of it over the last decade, or even since inception in 2008 here for most of these stocks. So some are cheap, some are not values at all. So we have this going on. 2 out of the 5 are not even values. But the ones that are values are not traps. So I'm kind of liking it, like I said, except you're going to have patience. And some of these value stocks can stay value stocks for a long time. So keep that in mind, that the street might not discover them. They've discovered EMPH for whatever reason and are like basically trading it, not really owning it. But as I said, the second half of this year is supposed to improve on the solar side. So some of these could be maybe some hidden gems in there. We'll see. But you're going to have patience, like I said. So let's recap those tickers again. EMPH is EMPH, First Solar, FSLR, Canadian Solar, CSIQ, Solar Edge, SEDG, and we had Renewable Energy Group, REGI. And then I tacked on that ETF if you want to go check that out. Expense ratios on that is 0.46%, so not super cheap on expense ratios. That's the iShares Clean Energy ETF, ICLN. And as always, I want to cover topics that you're interested in. So do send me your ideas, because this podcast came from an idea, and we haven't covered alternative energy stocks in a long, long time. They kind of just get thrown in with some of the other screens that we do. But this was an interesting area to take a look at. And I love doing the value versus value trap podcast. So maybe be taking a look at a couple other industries as we move forward here before earnings season starts again. So you want to subscribe. Be sure to get all of our episodes. We are on Spotify. You can find us on Apple Podcasts as a standalone and 2-for-1 on SoundCloud under the Zacks Market Edge name. Search for Zacks Market Edge. But otherwise, get us somewhere, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.